Hello people, welcome to Fortune Fastlane. What exactly do you look for before investing in IPOs? Luckily for you, Fortune Fastlaner, we got the answers. If you want more of this content, subscribe to the Fortune Fastlane YouTube channel and hit the notification bell. The current system used to be that IPOs were only given to institutional investors or high net worth clients. Thankfully, now with on-market, individual investors have the opportunity of accessing private capital raisings and listed placements. With questions related to investing prepared in advance, and those that may not be successful for potential IPOs avoided, what other mistakes should investors avoid? The prospectus is always the best place to go for information. Study up on the key figures and take notes to understand which parts are important in your effort to place a good investment. Understand the business. Warren Buffett attributed his success in part because he is able to stay within his circle of competence. If he cannot understand what a company is doing and lots of other people have the same difficulty, he stays away, and that's why he is successful. It is simple yet vital advice to remember. If you do not understand the product, don't invest. Companies should be clear in their prospectus about what they are selling and why it will solve a problem or fill a gap. Once you understand the business, it is easier to identify the market opportunity. The size of the opportunity and company's ability to capture market share determines growth. Shareholder returns and company performance, market size is just an estimate. Understand the risk. When it comes to investing in the stock market, taking risk is inevitable. The thing is, because there are so many choices and a wide variety of companies across industries, understanding the risk associated with each business beforehand is a good place to start. The market environment, competitors, and quality of the product or service are all factors that can impact a company before investing in them. Prospectuses should be read to identify risk specific to an individual company. Research company management. Focus on the prospectus listed director and managers. With the information you learned about their prior experience, how long they have been with the company, the salaries of the board members, and if they are well-rounded, you can infer how likely a prospectus is to be successful. Watch for any red flags. Ask yourself, are there signs of a less obvious problem? Do my numbers make sense? One sign to look out for is the position of CEO and executive chairman. Understand the capital structure. The extent of ownership that key management personnel like CEO, chairman, and directors have in a company will influence your investment decision. Having prominent investors and directors with a large stake in the business should be an encouraging sign. This doesn't mean that if management own fewer shares, the IPO isn't a good one. It may amount to more research is required about the company before you invest. Be sure to consider things like options and performance shares. Every new share will also impact your holding, and some of these may be triggered upon listing. This is important for the true value of your shares and the future of the company. Some owners may want you to retain skin in the game by offering a stake in their company after the IPO, including an escrow agreement and what percentage of outstanding shares are included in their offer. Know how the funds are used in your business. When companies go public, they must disclose how their funds will be used. The decisions you make now will affect the future of your investment. Evaluating where your money is going and what purpose it serves can affect the performance of your investments. Companies that spend their proceeds to generate new capital in the company should have an internal business incentive to grow. In a float, funds are pooled into a pool and typically then given to an advisor. Companies that intend to grow and invest in their future are more likely to be steady, promoting long-term success. Look at the financials, then check the valuation. A company's financial performance can provide insight into how it is using its resources and the historical development of its business. Company valuation also plays a role in what kind of investment decision you should make. The company may decline in value upon listing, and so you might be better off selling the available shares after they are trading on public markets. Of course, to determine company valuation and whether the company is duly priced and worth investing in, you should look at similar listed companies, their growth potential, their management team, and its competitive advantage. Know who the lead manager or broker is. With quality companies, a credible lead manager or broker seems to be the best way to bring them public. A company with robust due diligence conducted by a reputable broker provides trust in the new investment. There is no guarantee of success, and reviewing factors such as the number of shares that will be issued and how long it will take for new shares to be sold can help. IPO stands for Initial Public Offering, which means a private company going public by issuing shares to the general public for the first time. Every time an IPO happens, the company shares are auctioned off to investors in an open market. The primary reason for a private company to go public is to sell shares in the market. By going public, the company can raise the capital necessary to expand their business and grow successfully. Study the entire company. Look at the prospectus of a company which you're considering for investment. Analyze how they will spend funds and what their goals are. Be updated with the current market trends. Investing money in IPOs where the trend is higher will help contribute to your wealth. The IPO become more potent when the current market trend is rising. So wait to invest when the current market trends are favorable before you make the commitment. Monitor the volume. There is a high chance of IPO oversubscriptions, so it is important to keep a close eye on the number of applications received. Note that more applications means fewer shares for you by default. Know the intention behind investing. Before you invest in any company, it's important to know whether the company is going to grow and the sector in which they are working. To invest, it's best to know if the company is financially stable and have a clear understanding of their industry. The primary rule to investing in an IPO is not borrowing funds from anyone because it does not give guarantee returns. Regardless, if you lose it, all your crucial money will be wasted. Also, you should realize that all investments carry some degree of risk, and understanding the intended use of your investment is a wise move. Big names does not mean large returns. Many beginners mistake large companies for a good investment. But investing in the company solely because it has a high market cap does not mean you will profit in the long run. It is generally because they have substantial funds to invest in and their calculation skills are significantly different for their backing. If you want to know how much money a company is worth, then you need to see the facts and figures given in the prospectus. For example, before investing in an IPO, focus on a company's growth potential. Why is it important to open a demat account? To be an IPO, you need to have a demat account. The conversion process is quick, necessary for the administration of international trades. With the introduction of the demat account, traders had a simpler time trading shares. If a trader doesn't have a demat account, they cannot execute trade orders or buy shares in spot market. In order to gain access to the depository participants, you must open an account with any of the participating entities. There are, however, no requirements for opening a demat account. IPO performance and market trend are closely linked. A major trend in the stock market involves factors such as the price of stocks and the stock market's trends. Stock markets don't lead these trends. An IPO which is robust and financially strong in all terms performs well in rising trends of the stock market. And it is a quick way to earn money without any trouble. Wait till lock-in period is over. In the time period in which investors are restricted from selling their investments, they cannot sell until the lock-in period expires. When the lock-in is over, investors who have restrictions on selling their investment can proceed with selling the investment. If you have the patience to wait for the end of the lock period, you can predict a stock's profitability and avoid risk. Securities trading is safe when the lock period ends. What does IPO stand for? An IPO is a process when a private company becomes public. For instance, if you have the money to buy shares in many companies, your buying activity would create a demand for shares and thus cause the stock price to rise. You can even start an IPO with a business idea you think has potential. 3 points to keep in mind before investing in an IPO. First, size up the whole company. Second, be updated with the current market trends. Third, monitor the volume of application. While some are lucky enough to profit from IPOs, most people don't profit as much. With investor shares rising in value, many invest hoping for return, but only a few earn profits. When companies go public, their future seems unclear in the transitional period, but after the offering is complete, all investment decisions are clear and decisions will largely depend on investor sentiment. Investing in IPO can be challenging, and not every company will give you the return of your invested funds. Be sure to think critically about whether or not you are confident in your investment before putting money at risk. With your life, you invest both time and money in decision making. In other words, it makes sense that researching and analyzing before making a transaction is the same in the world of investments as choosing your career. It's important to remember some of the potential risks associated with investing in an IPO. Only if you tick a few boxes should you invest in an IPO. Let's go through some of the things you should consider before investing in an IPO. Ask yourself the right questions before investing in an IPO. An investment decision cannot be made without having clear goals and an understanding of your preferences. This leads to investing in a later stage company that is taking over the market. Investor expectations have already been set for the company and thus, it is likely to face adverse effects such as greater risk and more volatility. On the other hand, investing in an IPO launch by a large firm may help to balance your portfolio. Another factor to consider is your investment horizon. Do you plan on trading in the IPO for a quick buck? Or do you want to hold the shares for a longer period of time? This can change your strategy of investing in IPOs. New market conditions require a short-term investing plan, whereas thoughtful company fundamentals will require a long-term plan. You need to stop investing in the stock market and question the logic behind that. Ask yourself a few questions before you commit to the IPO. This keyword-driven question will typically test your outlook on investing over the short term. It's important to know if you are comfortable making a financial trade that might make or break your portfolio. How much of your portfolio are you investing? And what are your risk tolerance? One of the more common questions asked when investing is what options are available to invest. Do you plan on investing in a short-term strategy? Your decision affects how the type of IPO investments will change for you, and changes in your general investment approach can happen as well. Once you have decided on your investment goals and the best strategy to achieve them, you still have to choose the right IPO. There are many factors that can help in determining the best issue. The key factors are: a draft red herring prospectus is a document that has all of the financial information about a company, such as its current share distribution and qualifications. Look at how many shares are held by institutional investors and banks if you want to know whether the company is on top. With this information, you should find out who the management team is and see whether or not they have enough experience to successfully manage the company. That will tell you how confident people are in them. A key factor to look at is the entity which is promoting the IPO. Key promoters could be a company or an individual. A premium price can result from well-known names as well as ownership by an entity affiliated with government. The grading of an IPO is also an important indicator. While grading is a good factor to consider when making your investment decision, there is no definite equation for how much the grade influences your overall output. Companies with excellent grades have had to withdraw their IPOs in the past. To understand the company's mission, look at the target audience, product, and financial goals. This will help evaluate returns in addition to their current stage of development. People should not invest in businesses they do not understand. In the business world, this is crucial because it allows investors to make better decisions. It is always best to research a business and make more informed decisions rather than hoping for someone else to tell you what to do. If you feel like your financial goals, investment strategy, and research have been done prior to the IPO application, now is a good time to learn how to potentially apply for it. ASBA is a way of managing funds. You benefit from this facility because the cost of shares does not occur until the allocation has occurred, meaning that you do not pay for shares until they have been allocated to you. Once enough shares have been allocated, your bank account is debited and the investor's money will be released. That is it for this video, Fortune Fastlane. Remember to subscribe to our channel, and if you feel like we have delivered value, please share this video with one person. That's right, just one person as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you will start to see results. See you soon.